that's kind of our topic today. If you have not attended another webinar, or if you are not familiar with this strategy, you may consider attending one of our first 2 webinars, because this is going to be a very in-depth analysis on life insurance. You might be a little bit confused about what we're talking about. But that being said, we're going to go ahead and go into it. We're going to start with what we call the 10-minute lesson on life insurance. And what I'm about to show you is probably going to show you and teach you more about life insurance than anyone you know, including agents and other financial advisors. Most people do not understand how this product really works, and that's what we're going to talk about. So let's assume that you need some sort of life insurance coverage. We'll talk about a $500,000 death benefit. Keep in mind, this is an example. This doesn't apply to everyone or in the exact same way, but the idea is sound. So when you go on the search for a $500,000 death benefit, what you're going to find is that there's a minimum that you're going to have to pay for that coverage. But what most people do not know or have never heard of is what is a maximum on that same death benefit. Meaning there's a minimum amount that you can put in, and there's a maximum amount that you can put in for that particular death benefit. Now let's talk about these minimum and maximum areas here. Who do you think sets the minimum? And if you guess the insurance company, you're probably right. You are right. The insurance company is the one that determines how much they're going to need from each individual policy owner in order to pay out this death claim if something were to happen. Now the maximum, let's talk about the maximum. I'm going to let you guys type in the box there who you think sets the maximum here. But yeah, what do you think? Who do you think sets the maximum? Some of you probably already, yep, looks like some of you already know it. But who do you think sets the maximum? Yep, we're getting a couple of responses. Looks like most of you got it. That's right, it's the government. This, in some degree or another. Yeah, the government is the one that sets the maximum on how much we can put in for this particular death benefit. Now, between the minimum and the maximum, there are infinite product designs. You go to any insurance agent out there, you're going to find, every agent will bring something back different. Every company will bring something back different. There are a lot of product designs in between the minimum and that maximum. So let's talk a little bit more about what this maximum means. Let's say we go over it. What happens? Well, in the 1980s, the government instigated something that we call the MEC. And basically what that does is if we go over and above this maximum, those dollars are treated just like qualified plans. So the reason that the government is involved is for no other reason than taxes. And you probably thought that to some degree or another. Not a lot of accounts have maximums like life insurance does. And the reason that is because there's a lot of tax advantages when done properly, and the government has limited the ability to take advantage of a lot of that those tax advantages. So let's say we go over and above this this maximum. Like we said, it becomes just like a qualified plan. It's it's taxable if you take it out or you borrow against it. You have 59.5 rules. You have minimum distributions. It is exactly like any other tax qualified account. They want you to play by their rules and ultimately not be able to shelter all those dollars from taxes. Now let's talk a little bit for a second about the the idea of qualified plans. So if I ask you what does a qualified plan do, most of you will say they defer the tax. And that's correct, and I just want to suggest maybe a different word there that I like to use, and that is that they postpone the tax and the tax calculation. So you're not just postponing today's tax and paying that tax down the road. You're paying that tax plus whatever that tax grew to over that period. Meaning your account grows, so does your taxes. So you're postponing those tax dollars. So if today you're in a 15% tax bracket and tomorrow you're in a 30% tax bracket, is that really going to have done you any favors? Most likely not. Paying the taxes today at 15% would be far cheaper than paying them at 30% in the future. So do you think that you'll be in a higher or a lower tax bracket in the future? And to preface this, we have done a couple of podcasts, and you can go look that up on our site, becomingourbank.com, one of the podcasts, where we talk about taxes, and we have quotes from multiple CPAs that are not seeing their clients retire in lower tax brackets. It's just not happening, and I want to talk a little bit about those reasons now. But what tax bracket will you be in retirement? Well, a couple of things to take into account. Will you be making more money? Will inflation alone push you into higher tax brackets just by higher income? What are your deductions going to be come retirement? Will you have your home paid off? If you will, you'll no longer have a mortgage deduction. Kids out of the home. These are things that you've got to consider, and when you consider the inflation, more income in the future needed, when you consider kids out of the home, when you consider all of these different deductions gone, what we're finding is a lot of people are being pushed into higher tax brackets and ultimately paying more in taxes because of the postponement. Now, let's talk a little bit about the history of taxes. If you've never seen this graph, look at it pretty closely here. These are the highest marginal tax brackets that we have historically here. So if you take a look, you'll notice that throughout the years, tax brackets have been fairly high. So today, at 35%, I'm going to jump up here a little bit so we can follow it. But at 35%, that's pretty low compared to what we're used to. Now consider our national situation, government spending, all of our health costs that are going to come up in the future, all of our Social Security issues. Where do you think taxes are going to go in the future? Now let's say I've got an account balance today of $50,000, and we'll go down to a 20% tax bracket. And you decide not to pay the $50,000, and you decide not to pay the taxes on that $50,000, meaning you postpone the IRS's share here, this $10,000, meaning you have $40,000 of actual account value inside that account. Now let's say you postpone that and do end up in the 35% tax bracket. If you didn't grow any of those dollars, you're essentially increasing the IRS's share by 15%. No matter how you cut that or slice that or what that dollar figure ends up as, the IRS's share is larger. So on $50,000, that's a $7,500 increase in the IRS's share. So you really have a huge wealth transfer by overpaying taxes, by not understanding where you might be in the future. And not every situation is the same. But for the majority of people, we're finding that those tax brackets are higher in retirement. So back to our life insurance discussion. Basically, if we go over and above that maximum, it's just like you have it in an IRA, 401k, SEP, 403b. And we call that a modified endowment contract. Instead of calling it a 401k, IRA, SEP, the government calls it a modified endowment contract. Taxable account. So back to our life insurance. Let's assume that the minimum in this scenario is $500. That's what the insurance company needs to provide this $500,000 death benefit. The maximum we'll assume is $10,000. Now, as someone who is a smart shopper out there, for $500,000, you see you can pay $10,000 or you can pay $500. What does a smart shopper want to do? Well, you want to pay $500 because it's the cheapest. $10,000 seems like a lot of money when you could get it for $500. That being said, the minimum provides one benefit, death benefit. We call it term insurance. Now, term insurance provides that death benefit, but it's not without a cost. We talk a lot about wealth transfers or giving up money either unknowingly or unnecessarily. So when is the best time to have term insurance? Well, if you sign those papers for that policy and you walk out that agent's door and you get hit by a car, that's the best time to have term insurance. because every month's payment or every year's payment is gone and never can come back. That's a wealth transfer. So let's take a look at this for a little bit deeper here. So let's assume that you're going to purchase a $500,000 term policy at age 42, and you're going to purchase that for 20 years. Okay? Now at age 42, we're going to assume that that's $500 of premium. We're going to do that for 10 years. At age 52, that'll easily double, and we'll just assume it's 1,000. So by the time that you have purchased 20 years of coverage, at age 85, that cost or that opportunity cost on those premiums is $73,608, meaning you've paid $15,000 in actual premium, but you've lost $73,000 in opportunity cost. Now, most term policies don't ever pay out. About 1% of term policies pay out. And I'm not suggesting that there's anything wrong with term. It just has a certain need, and if it's not handled properly, then it can be a large wealth transfer, $73,000 in this simple scenario. If you have it even longer, it'll be even a greater wealth transfer. So now let's talk about moving up towards this maximum. If you're going to pay $10,000 for the same amount of coverage that $500 can provide, then there better be a lot of advantages. Now let's move aside from insurance for a second. Let's bring up our list of benefits that we wanted originally. Well, we wanted, and for those maybe that didn't follow last discussion, these benefits are essentially the ideal place, for money. We kind of created a list of ideal characteristics for our money. So tax-deferred growth, but also tax-free distribution. It'd be nice to defer those taxes, but also not pay them in the future. Competitive return, high contributions, no limits like qualified plans. Additional benefits such as lawsuit protection, that sort of thing would be nice. Collateral opportunities, like we talked about, and we want the ability to borrow against our dollars or collateralize our dollars to allow for continual compounding. Safe harbor, want some extreme safety in those dollars. No loss provisions, guarantees, knowing that our money will not decrease. Guaranteed loan option, no matter what our scenario, whether I lose a job or my credit's gone down the drain, that loan needs to be guaranteed option, not based on those things. And then the payments on those loans need to be unstructured to accommodate my circumstances as well. Liquidity use and control, ideal as well, and deductible contributions. Now back to life insurance. For us to get all of the benefits that we want, meaning that whole list minus the deductible contributions like we talked about last time, meaning we got to pay the taxes sometime to get rid of them today as opposed to in the future higher tax brackets. Well, most people when they shop for insurance are shopping for this minimum for the most amount of death benefit. But in order to have all of these advantages that we want, tax-deferred growth, tax-free distribution, competitive returns, high contributions, all of these advantages, we need to bring down the death benefit, kind of do this exactly opposite, bring down the death benefit and increase the amount of premium. By doing so, we create a situation where we have all of these living benefits. Now this is what we call a maximum efficient contract. Okay? This is a type of contract or policy that will give you all of these benefits that we want and need for our money. Now the difference here that I want to point out is with this minimum, yes, it's cheaper. We don't get any of the benefits of having our money there. We don't have any cash value, all those sort of things. But this is a wealth transfer. As money is paid into term insurance and it is not, utilized, that's money out the door. That is money that is a lost wealth transfer to us. This side of the coin, however, the most amount of premium we put in gives us an ability to grow our money, have tax advantages, all these sort of things that we want for our money anyway, without the cost of insurance that is a wealth transfer. Meaning we have our money in that ideal location and we get the death benefit as well, but it doesn't cost us out the door every month that'll never be used again. So we eliminate a wealth transfer by doing that. But let me ask this question. We've already talked about the fact that there are really no other accounts that have this type, these types of benefits. It just doesn't exist. But assuming that all of these benefits exist, the question has to be, well, how much of your money do you want to put in this type of an account? And for me, the answer is simple: as much as I possibly can. When you put money into a life insurance contract like this, you maximize these benefits. But these benefits are huge. The ability to access dollars is huge. It gives me the ability to move my money from my life insurance into other greater investments if I have them. It gives me the ability to purchase things like we talked about, recapture dollars. So that being said, that's really what we're trying to accomplish, is get all of our dollars in up until this maximum without going over. And that's where our specialty comes in, creating the design, creating the ability to maximize these contracts and ultimately have all of these living benefits. Now, one more thing to keep in mind is because we're decreasing the death benefits, increasing the living benefits, what happens is as you add more and more dollars to this contract, there's nothing that the death benefit can do but go up. I mean, if you add dollars into a policy and your cash value keeps going up and the death benefit stays the same, your cash value will ultimately be greater than the death benefit, and that's not insurance, and that's not legal. So the insurance company has to actually continue to grow your death benefit as your cash value grows. So throughout the life of your policy, you're going to have a death benefit that constantly grows as well. The longer you have it, the more value it will be to you and your family. Now, that being said, let's go ahead and look at a couple of case studies. All right, so here are our case studies. So I want to bring up first an illustration that we're going to look at a 35-year-old, just non-tobacco, just standard. And we're going to look at a particular policy, this one here first, that is more of a traditional type policy. This is normally what you'll see. And really this is why people have a hard time getting excited about life insurance, is because this is how life insurance is normally discussed and sold. Now keep in mind, this is actually even a little bit better than a lot of the policies out there that are in circulation. This actually has some cash value growing in year 3 and year 4, and I'll explain that here in a minute. But a lot of the policies out there just don't provide you a lot of value, especially in those early years. And so it creates potential value over time, but that time is far distant into the future. So before I reference kind of the structure that we've talked about so far, I want to reference this type of policy to show you sort of the difference here. So we got a 35-year-old puts in $10,000 this first year. We're going to look at $10,000 a year as somewhat of an example. So $10,000 the first year, the cash surrender value over here, we're going to look at this cash surrender value, is 0 in that first year. Second year is 0. You put in $20,000, you have nothing to show for it. Third year, $3,300, and then it starts to grow a little bit. But you'll see that in those first years, there's almost nothing there. There's no value, and so it's hard to swallow that $30,000 with about $3,000 to show for it. So what we want to do is maximize this contract to be able to create more cash value, to create more growth, to create more overall long-term value. So here's sort of an example of that. So I have stuck with the same $10,000 a year, 35-year-old standard non-smoker. You can find all that information right up here. But what you'll notice is it's a little bit different, and I'm going to be focusing on this column right here, this net cash value, as well as this increase in net cash value. I'm going to kind of focus on those two items as we go, as well as the death benefit. So we got this 35-year-old puts 10 grand in. So first year net cash value is $6,675. So as opposed to zero, we've got $6,675. Now, he's put in $10,000. He's lost a couple $1,000, right? Well, that is true. And the second year somewhat applies as well. Puts in another 10. He's got $15,676, which is a $9,000 increase, but he's still at a little bit of a loss here. Same with that third year. So by the time he's 3 years into this, he's given up, let's see, $3,500 plus another $1,500, so about $5,000 into this particular policy. So he's got 30 in and he's only got about 25 to show for it. Well, by the time he gets into this fourth year, he's put in 10 and he has 10 plus $102, so $10,102 increase in net cash value. So this is kind of a breaking point. Now every time he puts $10,000 in, he actually increases more than he's put in. So the first 3 years he puts in, he decreases the amount he's put in. Every year after the fourth year, he puts in and he increases every time he puts money in. Now let's fast forward down here to this age 65. Let's assume that that's kind of his retirement age. And again, this varies from person to person. If you're 45 or 55, it applies differently, but life insurance is a long-term strategy. And so it may take a 35-year-old 30 years to realize what I'm going to show you, where it might take a 45-year-old 20. So it's just a little bit different. It's not like your traditional investment account. So you want to see exactly how this works in your scenario. But anyway, at this point, if we fast forward 30 years, the cash value is $574,139, right? The increase in cash value when he puts in that $10,000, which is down to $9,906 at this point, is an increase of $33,000. So he puts in $9,900 and he has an additional $33,000 to show for it. This is pretty powerful. Every year you're getting more and more for your dollar. Anyway, for those that are very analytical, this is illustrating about a 4.2% return on those dollars. Okay, which is good, which is fine. We're in an environment where 1% in a bank account is an extremely high return. So, given our economy and our circumstances, that's actually very good, considering that that's conservative. Get ourselves in a little bit better economic environment, and those numbers will go up. So these are pretty conservative figures, which is fine. So 4.5%, 4.2%. But here's what I want you to notice. It's got $574,000 cash value. It's got $1 million in death benefit. Okay, so the growth has been there over this period, even though in the first couple years he's given up some of the use of his dollars. But overall, it's grown very well. But now he's got an extra, $450,000 or so. About $500,000 in death benefit that will pass on to his family if he were to pass away tax-free. So the first question that I would pose is this. He gave up the use of $5,000. The use of $5,000. I say the use of for a very specific reason. It didn't affect his long-term growth. His long-term growth was there. Excuse me. His long-term growth was there, even though he had to give up some of the use of those dollars. It overall worked out still in his best interest. Just in those first years, he had the loss of some of those dollars, the use of those dollars. So is it worth giving up the use of $5,000 to add another $500,000 to the value of your family? Again, give up the use of those dollars, not give up those dollars completely. He's got the growth, he's got the value, he's got it all there. He just didn't have it in those first 3 years. So is it worth giving up the use of those dollars for all those extra dollars in the future? For me, that's easy, yes. That's an easy answer unless my circumstance requires me to use those dollars. If I cannot give up that $3,500 those first year, if I need those dollars and I'm going to have to spend those dollars, then I'm going to have to postpone what I do in my policy, or I'm going to have to do less. If, however, I can postpone or I can give up the use of those dollars now, then I'm going to provide for myself a very good long-term strategy. Now, as time goes on, the growth gets better and better, and will continue to do so, which is good as you enter those retirement years. But the growth will become more and more efficient, and the rate of return will become greater and greater. Now, I talk about rate of return only because it's of interest, and it's what people want. It's what most people want to hear, or are used to hearing, I guess I should say. But let me make this very, very clear. This is not rate of return based. This is not investment based. Okay, this is your private banking system. This is very key here. Look, a lot of times you will come across opportunities where you can earn greater rates of return. Loans to family, loans to people you know, loans to whoever, real estate ventures. Maybe you have an opportunity to earn 15% or 20% inside a real estate property, a real estate deal, a loan, whatever that investment is. Again, this is your banking system. It does not stop you from doing that. In fact, I have done this multiple times where I have borrowed these dollars out. Let's call it 4.5%, 4%. 4% just wasn't enough. I had to have a greater rate of return. Well, I've done it many times where I've had a real estate venture. I've purchased property that I valued at about 20% of my about 20% rate of return on those dollars. And I've borrowed or taken the dollars from my policy to invest in those ventures. It does not stop me from continuing to invest and continuing to get greater growth from my dollars. This is just where money starts. Let it grow safe. Let there be a benchmark. If 4% is not enough, go get greater if you can. But for most, 4% right now is going to be very, very high growth. But again, if not, take it out. Those opportunities are still available to you. Now, let me add a little bit of a bonus here. When I borrow from my policy and I utilize those dollars for those investment purchases, when I purchased 2 properties last year, those dollars that I utilized from my banking system were actually dollars I wrote off when I paid it back. So it actually gave me a greater return on my investments because my tax liability was lower and I replenished my funds. Now, I've since paid that off. I've got the property, I've got the bank, I've got the death benefits, I've got the rental income, I've got appreciation over time. I've got the best of both worlds to some degree because I used my funds from my policy first. So do not get caught on this overall growth. It could be 3, it could be 5, it could be 7. It does not matter. The key feature here is the access to dollars and the ability to use those dollars. And inside your personal finances, when those dollars are utilized and then they're replenished over time, and when you're able to collateralize your policy to take out loans from the insurance company, and you're able to increase your cash value and your growth no matter what you do, continuously compounding those dollars, that is going to create a lot of long-term value. Okay. So again, this is just an example, but it's a very important example. Growth is there over the next 30 years. It's there with extra dollars to spare and pass on. Now, this particular individual is probably not worried about paying for term insurance. Again, term insurance, as you go through the years, is going to become more and more expensive, whereas this is going to become more and more efficient. This isn't transferring money. It's not a wealth transfer like those term costs are. Out the door, never seen again. It's dollars that are utilized and put to better use, and ultimately you're able to use them for whatever it is that you want to. So that kind of wraps up our case study here, but I wanted to illustrate some of those things. If you've been on the last 3 webinars, the intro, you've been on the nuts and bolts of infinite banking, and you've been on this, you're probably at a point where you need to be thinking about if this is right for you or not. And for some of you, it's not. It's going to require commitment. It's going to require giving up some of the use of those dollars those early years. Some of you may be strapped for those dollars and need them. It's going to be, those are some of the things you're going to want to consider. But give me a call. Let me know. Let's talk about it, because it's a phenomenal strategy for those that it fits. Now, one last thing in fact, we got a question about it, is about paying premiums. It shows $10,000 a year for the next 30 years. Want to address, and we got a couple of questions here about, 7 years. Can I fund it for 7 years, or do I have to fund it all these years? You do not have to fund all these years. In fact, the second that you stop adding premium, which could be in any year you want to, 5 years, 20 years, 30 years, 50 years, the second that those premiums and those savings dollars are no longer there, whether that is an emergency where you lose a job, whether that is just retirement, whether that is whatever that might be. These are one of our greatest specialties is the ability to manipulate these policies to eliminate premium and to continue to grow the cash value. In fact, grow it quicker at sometimes when it works that way. So yes, you can fund it 7 years. You can fund it 20 years. The thing to keep in mind is this is one of the best places to have money. We've talked about the advantages. We've talked about those things. So you want to save as much as you can, knowing you can always access it. I mean, look at year 20. You put in that $9,900, and you have an increase in net cash value of $22,000. You want to keep putting your money into that scenario where every time you put it in, it's worth a lot more. So keep that in mind, that you want to fund it as long as you can, because those are savings dollars. Those are dollars you can use for purchases now, for investments now, for opportunities in the future, and certainly for retirement. So that kind of wraps that up. We're going to get into some of the questions here. A lot of these questions are very specific, but let me reiterate something. You're certainly going to be able to adapt this to each of your different situations. Death benefit might be different. Premium might be different. The premium is what we structure it around. So you see the $294,065 death benefit that first year. That's based on the $10,000 premium. That could be a $20,000 premium. That could be a $50,000 premium, $100,000 premium. There's no minimum and there's no maximum. We structured around that contract premium. So keep that in mind. This is just an example. 10,000 is not the actual limit. It's the limit based on this particular death benefit. So another question here about the MEC. So the MEC in this scenario is the 10,000. In fact, let me scroll down here. Let me show you how efficient this particular policy is. So we want to get right up to the MEC, right? We want to put the most amount in for the least amount of possible